Hello and welcome to UTI Swatantra. We all want to earn a crore of rupees. Sometimes we'd like to do it in a 1-hour television show. Now, only very few people will succeed in doing that. If that does not work and you cannot make it work, let's try the other option, which is to invest slowly and surely and build a long-term nest. So, let's talk about Kaun Banega Corepati, but more importantly, Kaise Banoge Corepati. And to discuss that, I've joined by Rishad Amin from Kairos Capital, and I'm also joined by Jaideep Panikkar of Panam Capital. Jaideep is based in Pune and Rishad is here with me in Mumbai. Thank you both for joining us. So, Rishad, tell me, so when you think of becoming a Corepati, what is your, when someone comes to you and says, I want to become a Corepati, what is your response?
So I think the first thing you should do actually before you even start investing to become a Corepati, you really need to kind of have a couple of check boxes. I feel, you need to make sure that you have a budget. I've seen a lot of people who put up the social media posts where they say payday, and if you check with them 15 days later, there's no money left in the bank account. So it's important to have a budget to look at where your money is going, and so that helps you create space to save systematically. It's very important to have a little bit of a rainy day corpus, so an emergency fund, if you will. So 6 to 9 months of your expenses in a fixed some kind of debt or fixed income instruments, and paying down credit card debt is very important, because nobody can beat, if you're investing money, credit card interests are so high, you cannot beat the negative compounding of credit cards. So a 10,000 rupee liability will become 22,000 in 3 to 5 years, because it's such a high interest rate. So if you're investing, you need to make sure you can beat that, but that's very difficult.
But it's interesting, Rishad, you're the first person who's actually talked about credit card debt. And because you obviously see a lot of people who are racking it up.
Actually, I had come across a recent statistic that credit card debt has moved from 2% especially for young people under 25-year-olds. It was about 2% who had credit card debt. Now that's moved up to about 10%. So
in India.
So in India, yeah. So that's you increasingly see that there's a lot of people like this have started. They have much more access to new products and new things, and so they start spending more on the credit cards. So credit card debt, I would definitely check off, before you can start investing, and then.
So you're saying that don't have credit card debt, or if you incur something on credit card, make sure you have the ability to pay off by next month.
Yeah, I would say that if you have credit card debt, you should pay it off. It affects your credit scores. If you don't pay it down, your CIBIL score comes down, and therefore you will not be able to take home loans, auto loans. That it affects the ability for banks to give you loans.
Got it. So let's come back to the larger question, right? So when I've set a target of a crore, what should be my timeline? How do I best go about it?
So I think there's a good saying that, like, the best time to invest was maybe 20 years ago. The second best time is probably today. Time is your friend in investing. If you're young, say you're 25, 30 years old, doing an SIP of 3,000 to 5,000 will get you there by the time you retire, probably, depending on your return assumptions. But if you're older, it's okay. You just have to save a little bit more, to actually a lot more, to compensate for the number of years that are less. So if you're 45, maybe instead of a 3,000 to 5,000, you have to actually save 25,000 or 30,000 to get to that number before you retire.
Right, and you're saying 25,000 a month, is that?
Oh yes,
if you're older.
Okay.
And how would you split that, or how would you break that up?
I would probably put it basis the risk tolerance of the investor, and also depending on the time horizon for the investment. So if you have at least 10 years, then yes, you can take higher risk and put it more towards equity kind of mutual funds, but you need to kind of balance out the portfolio as well. So it really depends on the time horizon and the risk.
Right. So are there any rules to investing when it comes to going for big targets like this?
Yeah, I mean, once you've set a goal and you know how far away it is, I think diversification and asset allocation play a very good role. You know, the more risk you take, people are afraid of taking risk, but the more risk you take, you know, there's the potential for higher return. So if you're investing in fixed income, even say in a debt mutual fund, you know, the risk is maybe lower, but the returns will be more moderate. So you have to kind of see how much you're saving and kind of match it with.
Right. Okay, we had lost Jaideep for a moment. Jaideep, let me come to the first question, which is, if someone asks you, the kind of people you advise, a question like, मैं कैसे बनोगे करोड़पति, or you know, essentially, how do I become a करोड़पति? What is your response to them, or what would be your response to them?
My response would be very simple. The day you start earning, you start investing. The longer you remain invested, your chance of making a lot of money or becoming crorepati that increases that much. Now, for an example, if a 25-year-old person comes to me, I would advise him maybe that he can start with an SIP of say 3,000 rupees, and he remains invested for next 30 years. At a 12% average return, if we were to assume, he would become a crorepati. Similarly, if there is a 45-year-old person, if he does an SIP of say 20,000 for 15 years, at a rate of 12%, he would become a crorepati at the age of 60. So in the nutshell, one has to start early and remain invested as long as he can.
And obviously, when these are now very long targets, I mean, sometimes we talk about short-term targets, but today we're talking about what relatively is a longer-term target. You should not get phased by markets going down and up and so on, or periods like this where the markets may be going up, but because broad indices have not really risen, your mutual fund portfolio would still be looking weak.
Sure, I mean that happens. So it's what we have to do is we educate our clients that this is not a broad-based rally. Although the Sensex, the index is at all-time high, but the mid caps and the small caps are still much lower than their highs. So they need to be educated. The handholding has to be done. They need to be informed of what is exactly happening, and they should remain invested and stay the course. Volatility is the function of the market. It has always been there, and it will always be there. So one should not be afraid of the volatility, and they should continue doing what they are doing.
So, if I were to ask you to sum up, what would be the life rules when it comes to investing long term in the market and setting long term goals?
No, I didn't get your question.
So, you know, you should have some rules going in, right? I'm not going to I'm going to focus, stay focused. I'm not going to get scared. I'm not going to, you know, be swayed by what's happening on the Sensex. So there should be some rules that you should have when you go into a market with such long-term targets. So what would be those rules according to you?
Every year, as your income increases, you keep increasing your investment as well, corresponding to your income. Because the thumb rule is that you have to keep investing, and of course you have to be diversified. The portfolio has to be mixed of debt and equity, so that if at a time when the equities are not working, at least the debt portfolio will give the balance to the portfolio.
Yeah, go ahead.
I'd maybe like to add that, you know, to your point of the news, you know, I think there's the expectations for returns should also be rational. So if you understand how the Sensex has done over the last 10, 20, 30 years, that's a reasonable expectation to have in terms of equity returns. The problem comes in when we expect a lot of return and have very low, and then want to take no risk. There's no such game in the market.
So tell us about the time value of money.
So time value of money, I would say that, you know, if a vada pav cost me say 5 rupees maybe 20 years ago when I bought it from a canteen, today it cost me 35 or 40 rupees. You know, so as time progresses, basis inflation or something, the value the nominal value of it goes up. So when you're investing, you need to think that you need to actually beat that value. You know, if you don't, for example, if you just leave it in a current or savings account, your earnings will be maybe lower than inflation, and so your money value degrades over time.
Right. Okay. So we're getting some questions. Let's take a few of them. And Jaideep, I'm coming to you. The first question is from A. Sharma. He asks, is it possible to get 1 crore of rupees by investing only in mutual funds?
It is possible if you have a long-term horizon, and if depending on the risk profile, by having a balanced portfolio, yes, it is possible.
Okay. Another question, somewhat related. Which is a faster way? Actually, not so related. Which is a faster way to earn 1 crore rupees? Stocks or mutual funds?
Stocks obviously will be the much faster way, but one has to remember that there is a very high degree of risk in the stocks.
Right. Okay. To you, Rishad, I have D. Chatterjee asks, I have received an inheritance of 20 lakh rupees. How can I make this into 1 crore?
Well, I would ask him what is his time horizon, firstly. So
whatever the time horizon, it doesn't matter, right? I mean, if
well, I mean, if he doesn't want to touch the money, he doesn't have any use for it, at least for in the short term. Then why invest in a diversified basket of, I would say, securities like mutual funds or something like that, equity and debt both, and just let it sit and be patient with it.
Okay. Jaideep, let me come to you. Sunil Gupta, asks, is 1 crore rupees enough for my retirement?
Well, it depends the lifestyle that you are aiming for post-retirement. I mean, it's a very generic question. So it all depends on what is your expectation and what kind of life you want to live post-retirement. But yes, any kind of post-retirement life can be supported with that kind of money.
Right. Okay, so I think we've got a lot of questions which are asking for shortcuts, but let me, since that's what people are asking. Xavier asks, what is the shortest time to become a crorepati through mutual funds?
Well, I mean, if you start with 90 lakhs, you'll become a crore in a very short amount of time. So it depends on the starting corpus, right? So if you're starting with nothing, and as I said, if you're 45, 50, you could do it in 10 to 15 years. If your savings are much lower, it would take you much longer. But then, of course, if you can save 50,000, 60,000, 70,000, then the time horizon shortens significantly.
Right. Jaideep, can I put a question slightly differently? So, is there a time where you actually stop putting in money? Since we've got a couple of questions which seem to be coming from people who are closer to retirement. So, would you stop investing and then, really earning it back? Okay. I think Jaideep we've lost for a second. We'll come back. So let me put that same question to you, Rishad. So if is there you keep investing obviously when you're earning, but is there some time where you will actually stop, or you are forced to stop maybe, and then you only have to live off?
Yeah, I mean, that's what I mean. Once you retire, right, you're not earning your income anymore. In fact, I would go, maybe go back to the question of, is a crore enough? In Kaun Banega Corepati itself, I don't remember when they changed it, but at first it was a crore was the highest amount you could earn. Today it's 7 crores, right? So, if I'm not wrong. So, you need to kind of figure out how long that money can last you, because once you retire, you may need to use those funds for another 20 years or 25 years. So, will that corpus last you that long?
Right. So, 20-25 years is what you need to keep in mind, given the longevity and so on. Right. So, do you get people, I mean, this is more a sort of psychology question. I mean, you get a lot of people coming to you wanting to achieve these big returns quickly, and how do you counsel them or advise them?
So, I have quite a number of younger, younger clients, and I guess they're not really thinking of retirement, and so a lot of my counsel, when I speak to them, it's more about planning for more short-term things and making them realize and understand that they do need to have a plan for 20-30 years from now, even though that's a very far out goal in the future.
So you're saying build the capacity or the ability to focus on a goal, a financial goal, and then keep building.
Yeah,
new goals.
Build that habit of being systematic in your investing. Keep taking out money, putting out money for investment or for savings, and as your salary increases or your earnings increase, actually increase the amount that you save or invest, because your lifestyle also gets more expensive as you get older.
Right. So can you tell us about the power of compounding? Because the way it works is that I'm obviously putting small amounts, but those small amounts become bigger and bigger as they go. But tell us how you've seen it play out.
So compounding is I think Einstein said it was the eighth wonder of the world. It's a very powerful force. If you invest 100 rupees at 10%, it becomes 110 rupees. If you do another 10% of it, it becomes 121. So that 1 rupee over time compounds to a very big amount. So if you, for example, if you're doing an SIP of say 5,000 rupees, if you're investing for say 30 years, the corpus you've set aside is maybe 18 lakhs, but the amount that would, if you assume say 10-12% kind of return, over time that corpus of 18 lakhs actually becomes maybe 1.5-2 crores. So there's a massive increase in value from compounding. So it's a very important thing to keep in mind and have it work for you.
Okay, so we're coming to the end of the show. Mistakes that investors should not make, or should watch out for.
I think
particularly
maybe not look so much at the financial news. Things look very flashy, and sometimes there's a lot of gloom, or sometimes there's a lot of excitement. I think the thing to keep in mind is to just keep a track of your portfolio. Check on it once in a quarter. Don't really pay attention to what's happening in terms of the economy or the news, and but monitor your funds. Make sure you're invested in good funds, mutual funds or otherwise. Right. Don't have, as I mentioned before, don't have irrational expectations. Keep the return expectations reasonable.
Right. Jaideep, what would you say are the mistakes that people should not make or should watch out for as investors, long-term investors?
They have to keep, like you said, the expectation to the realistic level. I mean, they go back in the history and say 18%, 20%, which was possible in the era of high inflation. But when we are talking about the inflation of 3-4% with the interest rate at 7%, it would be really challenging to expect 18% return on the portfolio. So first they have to have a reasonable expectation on the return expectation on their investments. B, they have to remain invested for as long as they can. They should not churn the portfolio with the market volatility. They need to understand if the portfolio is not working, the reason behind it, and if the portfolio is a balanced portfolio, they should just progress and monitor the progress, but unnecessarily do not churn the portfolio unless the scheme, there is fundamentally something wrong in the scheme.
Right. Okay, and we've touched upon it, but we've not talked so much about the risk factor, right? I mean, when you assume, let's say, a certain rate of interest, or you project a certain rate of interest, there's also a risk which rides alongside, particularly if your portfolio is more equity oriented, which it would be if you're starting early in life. So, can you tell us a little bit about risk, Jaideep, and how do you see it?
See, there is nothing risk-free in any investment, right? So, every investment will come with some sort of a risk associated depending on the asset class that you have chosen. If somebody is into the equity, obviously it will carry a high risk compared to the debt portfolio. And within the equity, the direct stocks would have more volatility and more risk than the mutual fund equity schemes that we have. We generally recommend to start with mutual fund because it is more diversified. The professionals are managing it, and you get a lot of diversification in terms of you can have the sector, you can have various sectors, you can get the various geographically investments. So generally we advise that there is a risk in every asset class, but mutual fund is one of the best asset class equity to start with.
Right. Your sense, Rishad, on risk?
Yeah, I mean, there's no free lunch, right? I think there's risk in everything we do. It's not a question of whether there's risk or not. It's a question of how much risk are you willing to take, right? Even the latest stuff with the PMC bank has shown maybe depositors that even though the deposits are safe, there is some underlying risk, right? So when you take high risk investments in equities, for example, there is an underlying expectation that the return will be higher from that. Fixed income, although less risky, they will give you more modest returns. So you have to find out the balance which works for you, and that's where asset allocation comes in. And in fact, even in the mutual fund space, you do see hybrid asset allocation kind of funds that can do that for you.
Right. Right, we've run out of time almost. Jaideep, as you look at we're also getting into a new year, 2020. What is your advice going to be to people who are coming to you for advice?
Well, we see challenges going forward. The returns that we have made, say, 5 years before may not be repeated. Economy is going through certain challenges. The broad-based, we have not yet seen any broad-based rally, and I do not anticipate that happening for at least next 2 to 3 quarters. Yes, the markets are at all-time high almost, but that's because of the select few large cap index stocks running away. So one has to just understand what is happening, stay the course. Maybe 10%, 12% return is doable, but nothing beyond that. That is what it looks like as of now.
Right. Right. Stay the course, whether it's in the next few quarters or over the long term, and then if you've been systematic, if you've been diligent, persistent, and steady, then hopefully you will realize your dream of becoming a crorepati sooner than later, even if you're not able to go and crack those questions at the television show. Right. We've run out of time now. We're going to be back on the 19th of December at 5 p.m. with a new topic. Remember, this is the end of the year now coming up. 2020 is coming up. It looks like an exciting year. So let's talk about taking charge of your life financially, of course. So see you then on the 19th of December at 5 p.m. on UTI Swatantra. Thanks for watching.